Hey everyone! Welcome to the channel, The Formula for Success and Wealth, where you learn how to build assets and live wisely. One of the most common questions that pops up in the comments is, Duda, I have 100 reais. Where should I invest? It? Or if I can save 500 each month, what's the best option? But there isn't one single right answer. It depends on various factors. So the goal here is to give you a broad overview to help you understand what might be the most suitable choice according to your situation. Just a heads up, this is just a general outlook, because on the channel there are several full lessons that go into much more detail on each topic. You'll find the links to those lessons in the description. The first thing you need to understand is the different types of investments. They're usually divided into two main categories: fixed income and variable income. Fixed income works like this. You put in your money, and as long as you follow the conditions, you'll get a predictable return. In short, your wealth grows more securely. Variable income, on the other hand, operates differently. With it, your investment can bring in high profits, but there's also a risk of loss. That means you can either earn a lot or lose part of what you've put in. The names themselves are good reminders. Fixed income, because the return is stable and agreed upon in advance, and variable income, because the return fluctuates. It can rise or fall. Now let's focus on fixed income options. This category is best suited for conservative profiles that want to keep their money safe without surprises. In this case, you can choose an investment where the bank, brokerage, or financial institution clearly tells you how much you'll earn. If the agreed rate is 12% per year, that's what it will yield. Not more, not less. That's why it's called fixed income. To start with, there's the traditional savings account. Yes, it's still considered a fixed income investment, but it offers the lowest return among them all. Its annual yield is about 6%. Want a better option? Nowadays, digital bank accounts like Nubank, Inter, PicPay, PagBank and others offer higher returns just for leaving your money there. These accounts usually yield around 12% per year, are just as easy to use as savings accounts, and offer similar protection. If you're looking for something a bit above that, consider Treasury Direct, also a fixed income option, which can offer around 13% per year, depending on the bond you choose. It's safer and generally more profitable. Stepping up a bit, we have CDBs and LCIs. In my view, these are among the most appealing fixed income investments because they offer a balance of security, solid returns, and a conservative profile. It's a powerful combination. In some cases, they can pay almost 3 times more than a savings account. Don't forget, there are detailed lessons about Treasury Direct CDBs and LCIs in the description, where you can learn how to invest the right way and choose the best place to put your money. If you're seeking even higher returns within fixed income, there's another option I highlight often on the channel, the Inco platform. It's a form of collective investment, and its returns can reach 20%, 21%, even 21.5% annually. Very attractive, though it does carry a bit more risk, which I'll explain soon. Now you might ask, is it really safe to invest my money in something like that? Well, in general, fixed income is viewed as the safest kind of investment. Many of these products are covered by something called the FGC, the Credit Guarantee Fund. This protection covers up to 250,000 reais per CPF per institution if a bank or brokerage collapses or defaults. So if you've got, say, 50,000 reais in a CDB and the institution fails, the FGC will reimburse you. It's an important safety net. So which investments are covered by this protection? Savings accounts are. Most digital accounts are too. CDBs and LCIs usually are. Treasury Direct isn't backed by the FGC, but it's considered the safest investment in the country. Inco isn't covered either, but it offers other types of guarantees that make up for the lack of FGC coverage, especially when you look at the returns it can provide. There's a key principle in finance that you need to grasp. The higher the potential return, the higher the risk involved. It's impossible to have the safest investment in the world, paying the highest interest rates on the market. If such a thing existed, everyone would put their money there. If you consider yourself very conservative and don't want to take any risk, here's a good path to follow. Move your money from savings to a digital account. This alone can double your returns with the same level of security. Next, if you're ready for the next step, try Treasury Direct. Want to go further? CDBs and LCIs. And if you're willing to take a small risk for bigger gains, look into what Inco offers. This way, you can increase your earnings while keeping your risk profile in check. Now let's shift to variable income. Here you're entering a zone where returns are not guaranteed. There's no FGC, and while you might earn a lot, you could also lose everything. The advantage, the potential for much greater profit. While fixed income might offer 15% to 20% returns, in variable income, gains of 1,000% a year are possible in certain situations. Cryptocurrencies are an example. There's a full playlist on the channel about them. In 2020, for instance, putting 100 reais into a crypto called XS turned into more than 10,000 reais within a year. Incredible. But I've also invested in others that vanished completely. I lost it all. No insurance, no safety net, total risk. The same applies to stocks. You buy shares of a company, maybe a bank or a retail chain, and they might skyrocket or plummet. A well-known case is Magazine Luiza. Over 5 years, its shares soared nearly 100,000%, but the following year they dropped 90%. In other words, someone who had 1,000 reais ended up with just 100. That's how variable income works. The rewards can be huge, but so can the losses. Real estate funds are an interesting category within this segment. They behave more steadily, without the extreme ups and downs seen in crypto or stocks. They're not covered by the FGC and don't guarantee profits, but they're less volatile. Still, don't expect to get rich overnight with them. In the long run, they can be very beneficial with more manageable risk levels. There are also other options like gold, the dollar, and ETFs. All part of the variable income universe, all with profit potential and associated risks. So if you're just starting out, it's more sensible to begin with fixed income, savings, digital accounts, CDBs, LCIs, Treasury Direct and Inco. Once you've built a solid foundation and can afford to take on some risk, then it makes sense to explore variable income. Just don't start with it, because beginners are more likely to make mistakes. There's a phrase I often repeat: the more desperate you are to make quick money, the higher the chance you'll make bad decisions and lose everything. And then comes the question: I have 100 reais, where should I invest it? The answer depends on your profile. Are you open to risk? If not, and losing that amount isn't an option, then fixed income is your best bet. But if you can handle calculated risks, variable income might be a valid path, as long as you study carefully beforehand. Another crucial point is knowing how long you plan to keep your money invested. A month? A year? 10 years? This needs to be clear. Especially with fixed income, time frames are critical. Some investments can be withdrawn at any moment, like certain digital accounts or CDBs. Others require a lock-in period, 6 months, a year, or even 3 years. Knowing this is essential. If your goal is, for instance, retirement, then investing in something maturing in 20 years makes sense. But if you're planning to buy a car next year, putting your money in something with a 3-year lock-in won't work. The longer you can leave your money invested, the better your returns are likely to be. But if you withdraw early, you could lose money. So define your goal and choose your investment based on that. There are types of investments that will give you returns, but only if you follow the agreed conditions. Let's say you put money in a CDB that matures in 2 years. If you decide to withdraw after just 3 months, forget everything that was promised at the beginning. Those conditions are valid only if you wait until maturity. Pulling out early removes any guarantee of return. Then someone might ask, I have $10,000. Where should I invest it? It depends on your situation. Maybe you'll need the money soon, maybe in a year or maybe in 10. It's impossible to give a straight answer without knowing these details. You have to understand those factors clearly to know which investment fits your profile best. If you want, I can keep track of where the best deals are. It's similar to shopping at a mall. You compare prices at different stores before making a purchase. The same logic applies to investment platforms. Sometimes you're looking to invest in a 1-year CDB. At Interbank, it might offer a 13% return. XP could be at 14%. And Sofisa might offer 15% for the exact same CDB. The more accounts you hold, the easier it becomes to seize better opportunities. If you're holding a daily liquidity CDB at Rico and you notice PagBank is offering a more profitable option, switching makes sense. This ensures you're always securing the best possible return. Can I invest my money in different places at once? Not only can you, but you should. There are 2 key reasons for First, the more types of investments you try out, the more knowledgeable you become. Most people stick with savings accounts simply because they've never explored other options like CDBs, government bonds, or LCIs. Once you become familiar with these alternatives, it's clear there are far better choices out there. Second, diversification. Never put all your money in one place. That's risky. Think about investing everything in the stock of a single company like Magazine Luiza. If something goes wrong, like what happened recently with Americanas, you could lose it all in one blow. That's why spreading your capital across different assets is essential. It helps minimize the risk of total loss. Just like diversifying your investments is critical, preparing for unexpected life events is just as important. That's why I always recommend Azos Life Insurance. It's the best in the country, simple to get, quick to set up, and offers reliable protection for you and your family during tough times. It's unfortunate when you need to redeem an investment early due to an emergency. Azos covers death, critical illness, and disability caused by accidents. The link is in the description. You can get a quote in under 3 minutes. I'm confident. It's more advantageous than many other insurance options out there. And if you don't already have coverage, it's worth checking out. It's quite affordable. Can I divide my money between fixed and variable income? Absolutely. In fact, it's vital to understand what kind of investor you are. There are 3 main profiles. First is the conservative type, someone who avoids risks and prefers steady, secure growth. This profile is best suited to fixed income investments. Then there's the moderate investor, which is my own approach. This person places most funds in fixed income, but is open to allocating a smaller portion to variable income, such as stocks or cryptocurrencies, aiming for higher returns. Lastly, there's the aggressive investor, who puts everything into variable income. But this strategy requires a lot of research and a strong tolerance for risk. The mistake is when someone who barely understands savings decides to throw everything into variable income. I always emphasize this. You can put all your money in fixed income if you want, but never invest everything in variable income. And before I wrap up, I want to leave you with a phrase I always repeat here on the channel. When you invest in something you don't understand, your chances of losing money are much higher than of making it. Study, think it through, and understand everything I've covered here. Only then will you be able to choose what truly fits your situation. Whenever you invest, remember that knowledge is the key to making smart and safe decisions. So if this content helped you in any way, make sure to subscribe to the channel, hit the bell to get more tips like this, and share it with someone else who wants to learn how to manage their money better. Thanks for watching and see you next time.